Everyone, big week on Wall Street. Federal Reserve cut interest rates by 0.5%. So there's a lot of information that's out there as far as kind of the impact. Obviously, the markets have done really, really well in response to that. But I want to share some of my thoughts with respect to the timing of this cut and also the magnitude of it, because I think there's some very definitive winners and losers with respect to interest rate policy being, shifted to basically lowering rates. And I think the first thing, and I'll start with kind of who's disadvantaged as a result of this decision. Savers. Savers are being penalized. And this happened back in the great financial crisis where interest rates effectively went to zero. And for years, savers really had no ability to earn interest on any of their deposits or short-term. So short-term instruments like, money markets, checking, savings accounts, all of these different types of things were 0.01%, if not zero completely. And at that point, those investors needed to look elsewhere. They had to take more risk to get what ordinarily bonds had been historically able to provide to them. So that 3 to 6% range of interest for people that need income in a zero interest rate environment, they had to buy things like more risky types of bonds, hybrid combinations of stocks and bonds like preferred stocks, things of that nature that carry a lot more risk than your traditional kind of government agency bond or even a highly rated corporate bond. And that was out of necessity because there's this anachronism on Wall Street, TINA. There is no alternative. And in that case, in a zero interest rate environment for those types of investors that needed income, like a lot of retirees do, there was no alternative aside from moving into more risky types of investments. And that risk came home to roost in 2022, where interest rates rose very, very quickly as the Federal Reserve was actually raising interest rates to stave off inflation. So those things got hit by double digits, some of them losing over 20%. And this is really from a standpoint of investors that were just there because they needed to get a historical level of interest in that 3 to 6%. I just don't want to see things go back there. Now, of course, I have no control as to whether they do or don't, but I would be disappointed to see if we went back to a very low interest rate environment for deposits because of that fact. And I think obviously savers are, in this case, subsidizing the more risky and speculative behaviors of other types of investors. And it's being financed and basically run through the Federal Reserve. So the Federal Reserve, in effect, is saying that we're going to cut interest rates, make money cheaper, incentivizing those investors to take more risk, and doing so at basically the expense of people who are parking safe money in short-term and types of instruments because they know that they need it. So if you're going to buy a house, down payment, renovations to your house, looking to retire soon, you need a certain amount of years worth of living expenses, it was nice to have short-term instruments that were up over 5% because you were able to at least kind of keep pace with, if not exceed inflation and take literally very little to no risk. And that's starting to change as a result of this. The Federal Reserve also said that they're inclined to lower interest rates another 0.5% between now and the end of the year. And if they do that, that means that they've cut interest rates by 1 full percentage point in 3 months' time. That is an enormous movement in rates. And the stock market will likely love it, barring any kind of other unforeseen black swan event that comes out of nowhere. All else being equal, stocks will do very, very well. So it's a double-edged sword because all of us have diversified portfolios. All of us own stocks and bonds. And as stocks continue to grow and do well, the overall net worth goes higher as well. And that's a good thing. So I don't want to sound entirely negative about it, but I am a bit concerned with respect to the items that need to be parked in short-term types of instruments to take care of things that we know are going to, come up in the way of expenses. And I think that there needs to be a reasonable level of interest for those types of things. And I find it to be unfair that those people who are making responsible decisions to set aside known amounts of money to take care of their bills and not necessarily borrow to get the items or the income that they need, I don't like the fact that in essence, they're subsidizing more risky and speculative behavior that is ultimately geared for more asset growth coming from equities and stocks. It's my personal opinion. I welcome any kind of debate on that. I know that there's certainly very plausible, very reasonable points of view on the other side of that debate. But having done this a while and having had clients in zero interest rate environment where anything that was on the safer side of things was earning them effectively zero. And when you factored in inflation, it was actually negative. That caused a scenario where those types of investors were more or less forced to own different types of investments that carried higher levels of risk. I just don't want to see that happening again. So we don't know what's going to happen in the future. The Federal Reserve, I believe, my take is that they're trying to stave off any kind of change, negative change in employment. Inflation's still high. So at the end of the day, a reduction in a half a point or a full point on interest rates does nothing with respect to costs. When you go to the grocery store, fill up your car, go anywhere, spend money anywhere, reduction of interest rates is going to have absolutely no bearing on that. In fact, the reduction of interest rates makes more money available, which the Fed's playing a, kind of a gamble here. And, if the economy continues to kind of move along as it has, and there's more money out there, there's more money chasing fewer available goods, which can lead to inflation. So although inflation's been trending down, if this cut, and along with any other cut between now and the end of the year, that could lead to inflation taking back off again, which is going to have other consequences with respect to growth and could potentially push the economy into a recession. But that's conjecture at this point. So hopefully you found this helpful. I'm open to any comments, questions, or if you find anything that I say here, if you disagree, please put the comments down. We'd love to have a dialogue with you and just kind of get to the heart of kind of what you believe and how it is that you might want to be able to take a look at things for yourself.